Good afternoon, everyone. My name is Aaron Ploskow, Director of Sales here at AAMA. And with me today, I am lucky enough to have all of the portfolio managers from the Multi Market Portfolio Series, which we have been doing now for a number of years. So, we're going to delve into some of the questions that are on everyone's minds nowadays, and you will actually see how each of us deal with the market in our own way and how we all stay in our own lanes. So, with that, I'll just introduce everybody real quick. From Icon, we have Jerry Paul. Jerry, if you just want to give a little wave, there we go. From Main Management, we have Alex Varner. From AAMA, we have Rob Williams. And from Potomac, we have Dan Russo. All right. So I will jump right into it. We are in a gracious, well, let's not say gracious. We are now in the longest shutdown in history in government terms. How do you guys each think that is affecting the market and affecting the way you guys invest? That's the basic question that I think everyone wants to know about and that everyone's talking about. So, real quick, I'll start with Jerry. What do you think's been going on with this shutdown?
Oh, it's just such a politically driven activity. From my point of view, the markets seem to be, pretty much shrugging it off. We've had a little retreat lately in equities. I'll let the equity guys speak to that, but that seems driven more by AI issues and that sort of stuff than government shutdown. In the bond market, I'm basically paying little attention to it other than the airplane travel I have coming up. Uh, but from a bond management point of view, I haven't really spent a lot of time thinking about the issue, frankly.
Yeah. Now, from the bond standpoint of view, I'm sure the shutdown may not have as much effect on it, but the Fed has been starting to lower rates in here.
Mhm.
Um, is that a little bit more of a reaction because of the shutdown? I mean, is it more political? What's going on with that?
Well, I have several points of view on that. One is that some of the Fed people have started to express concern about the lack of data, and as they've made clear, they're data driven. So we could start to see some impact from that. To me, the handwriting's on the wall for the most part. The economy does appear to, in general, be slowing down. Labor's a question mark. Um, and we've got other ways of getting data on those things. Um, it could mean that, some people at least have been thinking there's two more cuts coming. Maybe it slows us down to one cut with a delay in a second cut if that's going to be forthcoming. Undoubtedly, and there's others smarter than I am on this, but, there's a pretty good size economic impact going on from the shutdown that isn't going to help the economy, and that could wind up, arguing for the next Fed cut or two cuts. Again, I will relate it to my own situation where I've got a lot of forthcoming travel, and I'm wondering, to the extent that I could, if I should delay on some of that. So, that's just one small example of potential economic impact going on, and I'm guessing that the other panelists, may have the same issues that they're facing as we all go out making marketing trips and that sort of thing. So there's that impact is going to show up in some of the numbers once we start seeing numbers.
Well, certainly what, a government shutdown of 30 plus days is going to have a direct impact in the short run on economic growth. I mean, government spending is a significant portion of GDP growth. Economically speaking, though, in times past, when we've had furloughed workers, as such as we have now, that economic debasement or slowing is quickly replaced with growth when the furloughed workers are recompensated. What's yet to be seen in this shutdown is the which if any of these quote unquote cuts will become permanent, and that's a difficult thing for anybody to ascertain at this point. So I think, from our standpoint, at least as a equity manager, from a discipline standpoint, we're not considering these things. They are certainly impacting the markets, but they haven't quite shown up in the fundamentals yet. So as far as we're concerned, it's steady as she goes, and it's important to stick with your discipline and not get too caught up in what's largely rhetoric at this point. I know, Alex, you have some thoughts on that.
Yeah, yeah. I think our CEO likes to say, look at the earnings. The earnings are kind of the fundamental driver on the market side of things, and that's where we've been. And I think you've seen this little, I don't know, hiccup the last couple of days here. I think part of that was due to just kind of maybe some over exuberance on the side of AI, and I think it's inevitable. It depends on how you define a bubble, but um, kind of looking at the expectations versus reality, and that's usually where things get a little shaky, is when reality doesn't match expectations, and there's a little bit of a reckoning, I guess, kind of squaring of those two, and then things are moving forward. But for the time being, we're continuing to focus on fundamentals. The earnings growth is really continued. This Q3 earnings season is playing out strong, and we're not kind of getting shaken out of our process by a government shutdown that is temporary. I think the lack of economic data certainly doesn't help, but people are figuring out pretty quickly how to source it from alternative places. ADP started coming out with their weekly, and they had their monthly piece yesterday. The Challenger Gray data, again, those are announcements only, but just examples of ways people are looking at alternative sources. As far as the Fed's concerned, I think maybe, what was it, Powell's reference of driving a car in the fog? Maybe you slow down a little bit, and maybe you postpone a cut, or that December cut that markets are expecting. But beyond that, it's kind of waiting and seeing. You don't want to react to something that's, again, yeah, the government spending is a component of GDP, but it's not. Private industry is really what drives this country, and I think that's been our keeping focus there and on the earnings.
Well, and what's clear, I think, at least become more clear publicly, is the sort of bifurcation within the Fed. Right, you certainly have one section of the Fed one sector of the Fed that seems to be with Chairman Powell and sort of the way I was traditionally taught economics, which is, they have two mandates in their charter: stable prices and full employment. Well, unemployment rate's 4.3%, and prices have moderated, but are still somewhat sticky, and we're seeing blips on the inflationary front. And we have 3.8% economic growth. So, they're saying, is this really a case where we should be cutting, rates 6 times as people have forecasted? Whereas you have a second completely separate sector of the Fed that's certainly more dovish, and they talk about the neutral rate, or where monetary policy should be relative to easing versus being accommodating versus being versus tightening, and they want that rate to fluctuate and help stimulate economic growth, which is outside of the charter of the Fed. But and I'm not suggesting that decisions should be made in a vacuum, but certainly the sort of older school thinking that Chairman Powell possesses, not necessarily what's going on throughout the entire board. And they've specifically cited the lack of government spending, or the decrease in government spending or fiscal policy coming out of the COVID pandemic. So specifically saying that monetary policy should be more accommodating because of fiscal policies So, certainly a much more dovish stance than what we've seen historically. That's a long way of saying, again, you know, the proof is in the pudding. And I know you guys have more fixed income emphasis than I do. Um, what we're seeing on our end is that the long end of the bonds is not confirming the Fed's, sort of short every time the Fed cuts rates, the long end sells off. So, the long end seems to be agreeing with Chairman Powell in sort of the historical approach in that, the longer term pressures are still higher prices and stickier inflation. But maybe you could address that.
We wouldn't expect long rates to follow short. Uh, I probably should note that, frankly, at Icon, we spend very little time thinking about both the Fed and interest rates. The studies show that, as smart as all of us are, we're wrong at least half of the time. And so we tend to focus on bottom up bond picking, and maybe along the way here today, I'll be able to give a couple of examples of that. But I would fully agree with the idea that we're moving towards more normalized yield curve where short rates are going to be, lower, somewhat lower, at least from where we are today. The longer bonds, I'll reference the 10-year, we think is probably stuck in this 4.5 zone. We seem to have an unannounced de facto move by the Fed to accepting a higher inflation rate than 2. And that's not going to be something that causes a 10-year or 30-year to rally. Uh, so I would expect, and again, I preface all of this with that I'm no better than anybody else and as likely to be wrong as everyone else on forecasting specifics. But I think we're going to wind up with a yield curve that, again, looks a lot more like the historical yield curves I've lived with for my 40 plus years of doing this stuff.
This is a good segue to say that's why you're included in the multi-market portfolio series. As the overall portfolio manager of the series, we're part of my task is to put together different styles that complement one another. And I think that that's a very good segue to say there's different ways to skin a cat, and that's part of why you're a part of this portfolio series. And to that end, maybe we could get some of Potomac's expertise here on not only the markets, especially fixed income markets, but how your sort of algorithm works to help put some controls on the portfolios, if you will.
Yeah, so I think it's an interesting topic in light of kind of the narratives that are playing out in the market right now. Because at Potomac, we utilize quantitative technical analysis, right, to build composite models to answer the question: do you want to be invested? We fully subscribe to the view that the market is a discounting mechanism, and if something is important, it shows up in price. Okay, I'm not going to sit here and guess what the Fed might do. I'm not going to sit here and guess where, inflation might play out or GDP might play out as a result of the government shutdown, or even in the absence of a government shutdown. We're going to follow the market-based data that we've always followed, under the assumption that if it matters, it shows up in price, right? So if I'm kind of looking at the market right now, we view the market through 3 lenses. What's the trend in the market? Up, down, sideways. How healthy is that trend as measured by market breadth? And is that trend confirmed by intermarket themes, right? I don't think anyone would argue with the fact that the trend in the market, S&P 500, NASDAQ 100, pick your favorite index, is up, right? If I wanted to try to poke holes in the market a little bit, I would probably start with breadth, because we are beginning to see some deterioration under the surface of the market. We are starting to see higher highs, right? The trend in the market is higher for the indices. However, if I look at the NYSE advanced decline line, it's kind of gone sideways a little bit. We're also beginning to see a growing number of stocks in the S&P 500 that are now trading about 20% from their all-time highs, despite the index trading within a couple of percent of the high. And if I think about intermarket themes, we pay attention to kind of the old school Dow theory concept of looking at the transports. They're fine. They're not breaking down. They're not breaking out. They're kind of fine. If I look at key sectors or industry groups within the stock market, like semiconductors, they're trading up near all-time highs. So big picture, it's kind of hard to get super bearish, regardless of what your narrative is, because the market-based data doesn't point to it. If I was going to look for hiccups, as I said, it would be within the breadth picture, right? In a strong bull market, you expect to see a lot of stocks going up. You expect to see a lot of stocks making new highs, and that is starting to falter a little bit. That is a big component. Breadth is a big component of our process and of our model. But what I would just say is this: it hasn't broken down yet to the point where people should be concerned. And, for those who remember the great Marty Zweig, he had a list of trading rules. Rule number 1, don't fight the Fed. Rule number 6, don't fight the tape. And this is more important than rule number 1. So if you're bearish right now, you're breaking rule number 1 and rule number 6 simultaneously.
That's great, and that brings up actually an interesting point, and you kind of gave a little segue to that I just want to get a few minutes on, is that everything seems to be near its highs, especially sector wise and everything. What do you guys think of these valuations going on here? Are we looking at the fact, I'm not even going to say that it's an AI bubble. Are we looking at just an overall bubble in general? Or is this AI that's leading the whole way, as it's 34% of the overall performance of the S&P? Is that, if that bursts, is that going to be a 25% downturn if we pop, or are valuations hitting a new norm up at these levels?
I can jump in here because I have a couple of views on this. Number one, I think there's a bubble in people seeing bubbles. That's number one. Take a look at an ETF like the Round Hill Mag 7 ETF, MAGS, right? It's not something we own. It's not something we trade. It's trading your all-time highs. That's fine. But look at it relative to the S&P 500. It is just now, over the past week or so, maybe 2 weeks, breaking out of a one-year consolidation. It is not like this group of Mag 7 stocks has been massively outperforming the broader market, to the extent that internet stocks were outperforming in 1999 and early 2000. That's number one. So I think there's a bubble in people seeing bubbles. Valuation, it's funny. We don't specifically look at valuation here at Potomac. It's not an input into our models. But I will say is this: I spent 10 years on a sales and trading desk where I covered institutional money managers, kind of similar to what Kim did, Kim Arthur from Maine, when he was at Bank of America and I think Montgomery Securities, right, Alex?
Yeah.
We had a very similar role in that regard. And I remember one time I was all excited to make a short call, or I was calling a hedge fund manager, because our analyst was short a stock or had a sell rating on a stock. And I thought that was interesting. And I led with valuation. I said, well, the stock is expensive. And that client hung up on me and then called me back a little while later and was like, listen, valuation is never a catalyst. If you're going to pitch me a short and you start with valuation, I'm going to hang up on you every time. Take a stock like Palantir. Everyone's looking at Palantir. It's trading 600 times earnings and saying, whoa, that's ridiculous. It was ridiculous at 100 times earnings. It was ridiculous at 300 times earnings. And it's even more ridiculous at 600 times earnings. But valuation needs a catalyst for people to wake up to the fact that it's expensive, right? So valuation in and of itself, in my opinion, and I think history bears this out, is not the catalyst. You get something that wakes people up to the fact that, oh, wow, this is expensive. Let me sell it.
It's interesting to note that if you look over the last 4 years, really coming out of the pandemic, it's other than large cap growth, cash has been king. The people were easily or quick to forget. The last 4 years, the cash is beating nearly every asset class. So
yeah, I think that's fair, and I think that speaks to the fact that it's not a bubble.
Or
Now, granted, I think yes, technology, the tech sector at mid 30% of the S&P 500 is clearly important. Look, if semiconductor stocks roll over, if Apple rolls over, if Nvidia rolls over, that's going to have a disproportionate effect on the market. It's not happening yet. As I said, these Mag 7 stocks on a relative basis, I would argue, are just starting to break out.
It's just interesting to note that I think all of us have reiterated kind of the same thing, that it could be a bubble, it could not. We don't know if it is or not, but it really doesn't affect our discipline in any way or the way
Exactly
we
right.
manage money. So, and that's sort of why, again, why you're all here with us. Alex, you had
Yeah, I
something to
think
say. I'm sorry.
Yeah, just here, here at Maine, we're fundamental with a catalyst, and as Dan said, fundamental starts on the valuation side, and every month, we're looking at kind of our shopping list of sectors, industries, what have you, as far as where they screen up relative to themselves historically and relative to the market historically, and you'll see stuff that is dirt cheap, and you look for a reason. I mean, energy comes to mind recently, and that thing's tied to oil prices, and until we see a real strong catalyst and decide if that's going to drive oil prices meaningfully higher, we don't have a reason to go into that sector. And that's for kind of everything we do, where when we, initiate a position, it's a 12 to 18 month period over which we think this catalyst will play out. But a key part of that is the catalyst. And we're not investing in an area that doesn't have a catalyst. And I think, you can look across the sectors and obviously tech, communication services at 34 or 40% are very important. But there are areas that, are also not decidedly not seeing that same sort of behavior. I mean, it was a stat I saw the other day where consumer staples is now less than 5% of the S&P for the first time ever. That's something that's going in the other direction, at least from a market cap standpoint. And part of that is obviously, you cede share to other places that are taking it from you. But I think that's an example of something where could say, all right, this is, to Dan's point, this is getting cheap on a valuation basis, or it's looking more attractive on a valuation basis. At what point do we see a catalyst out there that could initiate a move? And for the time being, we're not seeing that. But again, as the economy moves forward, if you start slowing down and you start, what are we waiting for this recession that is yet to come for the last couple of years here? Maybe that starts becoming a larger booming picture. And then something like staples maybe starts becoming more attractive from a catalyst as far as, business cycle goes. But I think the point is that the valuations don't, tell you part of the story, but certainly are not the whole investment thesis.
Now, just to wrap things up here real quick, I have to say we've done these in the past where we've had each of our CEOs on. I think it is a more important look that we actually have the guys who have their hands, needless to say, on the trigger of the actual investments, which is a different way of viewing things. And I think this is great. If we had all day long, we could probably continue this conversation. I want to be sure that we are understanding to our advisors and their time. And I'm going to look forward to seeing the next catalyst that gets us all together so that we can talk a little bit more. I greatly appreciate all of the panelists here for coming on, and remind you all that we each have our own role in the MMP portfolio, which you have heard here, and they all work very well together. So reach out to any of us to talk more about it. And I'll wish the rest of you to have a great day. And thank you so much for joining in.
Thanks for having us.
Nice talking with you, man.
Take care.